The numbers are staggering. It's an economic weight, a burden on millions, and it shapes their lives in profound ways. We're talking about student loan debt, a colossal $1.73 trillion now weighs down the American economy. It affects over 43 million people across the country. For many, it feels like a trap. You might think you understand the problem, but the sheer scale and complexity are often overlooked. It's more than just a big number. It's a system, one that has quietly reshaped the lives of an entire generation, and the consequences are just beginning to be fully understood. Today, we're going to untangle this immense financial web. We'll explore how student debt became overwhelming and what it truly means for millions of Americans. To truly grasp the student debt crisis, we first need to understand three core things. First, the sheer growth. The average student debt has not just risen slightly, it has exploded. Since 2009, that average has increased by more than 230%. Imagine your car loan or your mortgage growing by that much in a little over a decade. It's a jump that far outpaces inflation. It far outpaces wage growth for many professions. It means today's graduates face a financial line that is fundamentally different from their parents. Second, student debt isn't just a niche problem. It's a major player in the American financial landscape. It's now the third largest category of household debt, right behind mortgages and auto loans. Think about that. We often focus on housing and car payments when we discuss consumer finances, but student loans are right there, often dwarfing credit card debt or other personal loans. This isn't just about college students anymore. It's about how American households structure their entire financial lives. It dictates whether they can buy a home, whether they can start a family, or even save for retirement.
Third, this debt isn't evenly distributed. The average debt varies significantly by state, and even by what you choose to study. Washington, D.C., for example, leads the nation. Borrowers there carry an average debt of nearly $55,000. Maryland and Georgia also see high averages, both over $42,000 per borrower. These aren't just abstract figures. They represent real people in real places making real financial decisions under immense pressure. And your major plays a role too. If you studied behavioral sciences, for instance, the median debt could be over $42,000, but other fields might see much lower figures. This highlights a complex reality. The value proposition of a college degree is increasingly fractured. Some degrees offer a clear return on investment. Others leave graduates with substantial debt and uncertain job prospects. So we have a rapidly growing, systemically important, and unevenly distributed debt. But how did we get here? How did something designed to open doors become such a heavy chain? That's where the real story begins. To understand the student debt trap, we need to go back and look at how the system was initially designed. For decades, higher education was seen as a public good, an investment in the nation's future. Funding for public universities came largely from state governments. They subsidized tuition heavily. This kept costs relatively low for students. It made college accessible to a broader range of the population. Federal grants, like Pell Grants, also played a significant role. They helped low-income students cover tuition and living expenses. The idea was simple: talent should not be limited by income. If you had the grades and the ambition, a college degree was within reach. Loans existed, of course, but they were often a supplementary measure, not the primary way students financed their education. The cost of tuition, when adjusted for inflation, grew at a much slower pace. Graduating with thousands of dollars in debt was the exception, not the norm.
An expert in education finance from the U.S. Department of Education might have told you then that student loans were a vital safety net. They were there to smooth out temporary financial bumps, to ensure students finish their degrees without undue hardship. But that's not the whole story anymore. Here's where it gets interesting and complicated. Starting in the 1980s and accelerating in the decades that followed, a major shift began. State funding for public universities started to decline drastically. States faced budget pressures. They cut support for higher education. For every $1 a state used to contribute, they began to contribute less and less. This meant universities had to find new revenue streams, and the easiest place to find it was through increased tuition.
Tuition prices began to climb at rates far exceeding inflation. It was no longer an investment states were willing to fully make. They pushed more of that cost onto the students and their families. At the same time, the perceived value of a college degree was soaring. A bachelor's degree became a de facto requirement for many middle-class jobs, even for jobs that historically didn't require one. The message was clear: go to college or risk being left behind. This created a powerful, almost inescapable demand. More students were going to college. College costs were rising, and state funding was shrinking. This created a perfect storm for a new reliance: student loans. As tuition rose, federal loan programs expanded. They were designed to fill the gap left by declining state support and to meet the growing demand for higher education. More money became available for students to borrow, and universities, facing less oversight on pricing, had less incentive to keep tuition down. If students always could borrow more, why not charge more? It's a classic economic feedback loop. And it largely removed the cost-conscious consumer from the equation. If you were a student trying to get an education, you weren't truly shopping for the cheapest option. You were shopping for the best education you could get, and borrowing was simply the mechanism to get it. You might be thinking, well, people should just choose cheaper schools or less expensive majors. But the reality is far more complex. The full picture reveals a system with deeply entrenched incentives. For students, the incentive is simple: get a degree, any degree, because without it, your earning potential is severely limited. Even if it means taking on a significant amount of debt. The data shows that on average, college graduates still earn more lifetime than those with only a high school diploma, but the cost of getting that degree has become a massive gamble. For universities, the incentives are also clear. They want to attract the best faculty, offer the best facilities, and compete for students, all of which cost money. And with dwindling state support, tuition increases become a necessity, or so they argue.
For lenders, primarily the federal government, but also private institutions, the incentive is to provide the loans. It ensures access to education. It stimulates the economy, and especially for private lenders, it's a revenue stream. The problem is that student loans, unlike other forms of debt, are incredibly difficult to discharge. Bankruptcy offers little relief. This makes them a relatively low-risk investment for lenders because the borrower is almost always on the hook, no matter what. This creates a system where everyone has a reason to keep the carousel spinning. Students need degrees, universities need funding, and loans provide the bridge. But the person ultimately holding the bag, the one with the least power in the equation, is often the student, trapped between the necessity of a degree and the burden of unshakable debt.
Here's what we're really looking at: a sprawling, intricate system where good intentions have created unintended consequences. The problem isn't just irresponsible borrowing, it's a fundamental disconnect. We have a societal expectation that everyone needs a college degree to succeed. Yet we've systematically defunded the public institutions that once made that accessible. The result is a reliance on debt that has grown monstrously. The estimated $1.73 trillion debt isn't some accident, it's the logical outcome of decades of policy choices. Each piece of the system contributes. Declining state funding pushes up tuition. Rising tuition necessitates more borrowing, and expanded loan programs facilitate those increases. Why hasn't this been fixed? Because there are competing interests. States don't want to raise taxes to increase university funding. Universities don't want to cut programs or facilities, especially when they're competing for students. And the federal government is trying to balance access to education with fiscal responsibility, often using loans as the primary tool. It traps people. Imagine a young person straight out of high school. They're told college is the only path. They see the tuition, the cost of living. They don't have savings, their parents don't either. So they sign the papers, they take out loans, not because they want to, but because they feel they have no other choice to secure their future. They are operating within the logic of a system they didn't create.
A system that has decided access to opportunity must now come with a heavy price tag. So, what does this all mean for us? This isn't just about numbers on a ledger. It's about delayed life milestones. It's about people putting off marriage, homeownership, or starting a business. It's about stress and anxiety, knowing that this financial obligation follows you for decades. It's about an entire generation feeling a weight that previous generations didn't have to carry in the same way. The problem of student debt forces us to ask a crucial question. What is the true cost of opportunity? Is a system that requires individuals to bear such an immense financial burden truly sustainable or equitable? Perhaps a different way of thinking about higher education, not just as an individual investment, but as a collective societal good, could lead us to different solutions. Solutions that prioritize access without the crushing weight of endless debt. Imagine a future where the path to knowledge doesn't begin with a mortgage-sized loan, a future where education truly empowers rather than encumbers. That future remains to be built.